In this video, we're going to talk about the share rollover, specifically the Section 85 rollover. And the best way to go about this complicated tax issue is to go through the main details regarding the elected amount, and as well as actually going through the form and showing you an example of how that would look when you file the T2057. If you don't know, a share rollover is used to defer taxes, defer any taxes paid. Generally, it is when you want to either move assets to another corporation. It can be used to also, instead of selling your company, you want to give it to your children, but you don't want there to be a tax implication of doing so. So the CRA allows you to elect a share rollover, which allows you to not have to pay any tax until a later date. Now, what's very important here is that you have the elected amount. And a couple of things you actually have to know when you're looking at this is your elected amount. You also need to know what a fair market value is. So you have to know what your fair market value of whatever you are rolling. So let's say in our example, you're giving an asset, a non-depreciable asset, okay, this property, over to another corporation. The reason why you're doing this can be either you're a sole proprietor trying to incorporate. You can just be a person, an individual who owns shares of a Opco and you want to give it to or transfer it to a Holdco. So there's many different purposes here, okay? But what you need to know is your fair market value. That is, what is that worth today? And whenever you're doing a rollover, what you receive and what you give, the fair market value have to be equal. But what you decide, or the tax implication, is based off of what we call this elected amount. When you're deciding what to choose, you need to figure out what amount can we choose, what is the ceiling and what is the floor. So what is the highest amount we can choose and what is the lowest amount. When we are doing these share rollovers, we want it to have no tax implication. So we're not going to look at certain instances where you may have non-capital losses or net capital losses and you want to apply them and then have a capital gain. Okay, so you actually want to create a capital gain so you can apply to those net capital losses. And, we're not going to get into the specifics of having to actually create a loss where, you create a superficial loss and it gets denied. Okay, so we're not going to do that either. We're not going to take a look at that. All we're looking at in this video is to create a tax deferral completely correctly without getting into too many difficulties here. So when you're looking at the elected amount, you want to look at the floor. Okay, you want to look at the floor. You don't want to look at the ceiling, because the ceiling, you'll have some sort of tax implication. There will be a gain. But you want to look at the floor. So again, if we are looking at, let's say, rolling over shares of an Opco, we're going to look at the floor, which is the greater of two things here. Your fair market value of non-share consideration, that is your boot, that's also called the boot, and the lesser of two things. So you're going to look at the greater of these two, but before you can get that, you need to find what the lesser of these two are. So your fair market value or your ACB, and then the greater of your fair market value of your boot or your asset. So in general, to create no tax implication, we're just going to look at this ACB of the asset. And the best way to do so is if our Opco shares are worth 100,000 and our ACB of these shares are worth 40,000, we have to consider what our elected amount will be. Your ceiling would be this 100,000, but our floor will be, again, the greater of these three things. So we're going to see here your ACB. So we know that the ACB is 40,000. So we want the elected amount to be 40,000 so that there's no tax implication. Okay, we need that elected amount to be 40,000 so there's no tax implication. In theory, then, this would be 40,000. And then we look at the greater of this one and this one. So we would also want your fair market value of your non-share consideration to be no greater than 40,000. Okay, so we can keep that elected amount at 40,000. When you are receiving, so you're giving up these shares of Opco, you're going to receive shares of Holdco for that. Okay, so you're giving up Opco shares, okay, Opco, and you're going to get Holdco and vice versa, right? So Holdco is going to get Opco. You're going to give your shares of Opco are going to go to Holdco, and you're going to get shares of Holdco in return. And everything has to be at fair market value at the end of the day. Okay, so we're going to go in and show you how this looks like. We're going to look at the legal description of the disposed property. This is the category for your capital property. There's a bunch down here, whether it's depreciable or not. Here we can look at our shares only. So this is the capital property for shares. Number and class of shares are going to write in whatever. the fair market value of the disposed, okay, 100K. This will just be whatever the number is, but it'll be Opco shares, okay? And it'll be common shares. Your elected amount or your cost base was 40,000. And our agreed amount, so this is right in the beginning here, you have your elected amount, which is your fair market value. This first category is your fair market value. And your cost amount, which is your ACB, okay? Your agreed amount is the amount that you elect between the fair market value, which is your ceiling, and the floor, which we're going to say 40,000. Now, if there's any difference between 523 and 522, then there is a tax implication. There will be some income either in capital gain or in something else, but there will be a tax implication here. Since we're doing 40,000 minus 40,000, this is 0, and we now know that there is no tax implication at this point. We can look at the description of consideration received that is non-share. So we may be receiving, let's say, a P note. Okay, a P note in advance, which is non-share consideration. And we can look at the fair market value of the consideration received that is non-share. So this part will always be equal, or in general will be equal to this 40,000 when you are doing it correctly. And if you have the cash, etc., this is very good to have non-share consideration, getting something tax-free. So it'll be very easy as the Holdco is generating income. If it generates income, through a dividend of Opco or whatever, then you will be able to pretty much get this 40K tax-free because it's a P note worth 40K, okay? And your number and class of share consideration received. So this will be likely preferred shares of Holdco. And you're going to look at the fair market value of the consideration received. So now we know that our fair market value is 100,000 of what's being disposed. Our fair market value of the non-share amount is 40,000. So our fair market value of the consideration received for the share has to be 60,000 because they have to be equal. So 526 plus 528 is 100,000. And both of these have to be equal in order to be correct, okay? So we're getting non-share consideration of 40,000 and share consideration of the preferred shares at 60,000. What that means is we're deferring that eventually, if you sell or you redeem the preferred shares, that'll be worth, 60,000. That'll be your fair market value. You'll have to pay tax on that eventually. But for now, there is no tax trigger here. We have our elected amount. So we're essentially transferring over Opco shares, okay, to the Holdco, and we're getting the Holdco shares, the preferred shares, which have a fair market value of 60,000. Okay, and that's what we're doing, and there's no tax implication here. Zero tax implication here right now. You don't need to have a non-share consideration. This could be 0 and this could be 100,000 and this would still be correct. But the reason why you have non-share consideration or a boot is because you can easily get that money back tax-free. So when you are looking at this and you do the transfer, your ACB of this preferred share will be your elected amount minus your fair market value of the boot. So if we go back and we just erase this. So we want to know what the ACB is for that amount. Our ACB will be the elected amount minus your fair market value of the boot. So our elected amount was 40,000, right? This was our elected amount. And our fair market value of the boot is 40,000. So our ACB of our preferred shares is 0. So when those shares get sold or redeemed, right? If they get redeemed, you'll have a deemed dividend of 60,000. And if you do sell it, or if there's a deemed disposition on death or whatever, then it'll be 60,000. If the value hasn't changed, preferred shares generally hold their value, they don't move. And the cost base will be 0, so you'll get a capital gain there. You'll pay tax on that implication, okay? So that's pretty much it when it comes to the share rollovers of a Section 85 and the basics in terms of very simplifying, trying to simplify this tax in some way. Of course, if you don't understand this, don't worry so much. This is greater detail. This is more complex tax planning. If you do have any questions, do let me know. If this video helped, subscribe and like this video. Remember, this is general tax information, not personalized tax advice.